Welcome to this explainer. Today, we are opening up a really fascinating detective case. We're going to run a complete financial health check on Nomura Holdings, trading under the ticker NMR. Now, if you follow the financial sector, you already know Nomura is this massive global financial services group. But its vital signs right now, well, they are incredibly complex. We've got some numbers that literally look like an absolute dream for value investors, and then we have others that are flashing glaring red warning lights. So let's put on our detective hats and figure out what the data is actually telling us. All right, here's our roadmap for today. First, the undervalued mystery. Second, a surge in recent returns. Third, the heavy debt reality. And fourth, profit margins and efficiency. Let's dive right in. Section 1, the undervalued mystery, uncovering the discount. Okay, this is the massive hook that catches the eye of virtually every value investor out there. 59.66%. I mean, this isn't just some minor dip. This is a staggering 59.66% margin of safety. In the world of stock valuation, finding a large cap financial institution trading at nearly a 60% discount to what it's mathematically worth, that's the kind of thing that makes you stop dead in your tracks. It really serves as the main anchor for our entire analysis today. Just as a quick refresher, so we're all on the same page, the margin of safety is basically the percentage difference between a stock's intrinsic fair value, what the underlying business is actually worth based on cash flows and earnings, and its current market trading price. It's your buffer. And a 60% buffer means the market is incredibly, almost suspiciously pessimistic about this stock. To really put the sheer scale of this disconnect into perspective, look at this. At the time of this data, Nomura's last close price was a mere $7.87 a share. But when you look at the calculated fair value price based on its fundamentals, it's sitting way up at $19.51. That is a stark, undeniable contrast. So the big question we have to ask ourselves as we go through the rest of this explainer is simply, why? Why on earth is the broader market pricing this asset so incredibly low compared to its fundamental worth? What does the market know that a simple valuation model doesn't? Moving on to Section 2, a surge in recent returns, focusing on short-term momentum. Oddly enough, despite being priced so low, the short-term explosive data makes that massive discount look even more like a potential steal. Over the trailing 12 months, the total return is a very impressive 38.07%. But stretch that out to a 3-year timeline, boom, you're looking at a phenomenal 123.45% total return. And this isn't just weird speculative price action either. It's backed by actual net income growth. Their net income compound annual growth rate over the last 3 years is up a massive 45.68%. If you were looking purely at these recent metrics, you'd probably think Nomura was the hottest growth stock on the market. But a closer look at the yearly breakdown reveals the wild volatility you have to stomach to actually get those returns. You have a fantastic 2025 showing a 50.49% return, and a really solid 2024 at 34.08%. But zoom out slightly to 2022, and you're suddenly looking at a negative 10.30% return. And the year before that was down 18%. This really hints that this short-term surge comes with some extreme stomach-churning swings. And that brings us to this absolute plot twist. If you bought and held Nomura for the long haul, say over a 20-year timeline, your return is actually profoundly negative, down 58.28%. Ouch. This right here is the catch. Despite the phenomenal recent 3-year run, long-term investors have been severely punished. This perfectly sets up our need to figure out exactly what structural anchor has been dragging this company down over the decades. Which brings us to Section 3, the heavy debt reality. Time to lift the hood. It is time to investigate what is driving that dismal long-term performance. And here, my friends, is the elephant in the room, 10.28. This is Nomura's debt-to-equity ratio. Suddenly, this acts as a major speed bump in our optimistic value narrative. Think about it. For every single dollar of equity the company has, it holds over $10 in debt. Now sure, financial institutions naturally carry higher debt loads than your average tech or retail company. We know that. But a ratio north of 10, that is undeniably heavy. It weighs down their flexibility and makes them highly sensitive to shifting interest rate environments. And the plot thickens even more when we look at liquidity, meaning how easily they can pay their immediate short-term bills. Both their current ratio and quick ratio sit at a startlingly low 0.24. Let's use an analogy here to picture this. Imagine you own a massive multi-million-dollar mansion filled with expensive art. Technically speaking, you are very wealthy, right? But when the pizza delivery guy shows up at your door, you look in your wallet and realize you literally only have 24 cents on you. You have assets tied up everywhere, but very little liquid cash on hand to handle sudden obligations. For a major financial firm, that is a severe constraint. Finally, Section 4, Profit Margins and Efficiency. Checking operations. Okay, so with that debt reality in mind, we start our efficiency check with what is actually a genuinely positive sign. Their net profit margin sits at a decent 7.57% over the trailing 12 months. But what's more important than just the number itself is the trend. This is an improvement. The 3-year average was only 5.57%, meaning they're currently operating with better profitability on their revenues than they have in recent years. Basically, management is squeezing more actual profit out of every single dollar that comes through the front door. But we have to perform a balancing act here. While those margins are improving, it completely contrasts with a shockingly low number, 0.64%. That is their return on invested capital, or ROIC. Now, this metric tells us how well the company generates cash flow relative to the capital it has actually invested into its business. Generating less than 1% return on your invested capital is frankly abysmal. It means that despite the improving profit margins, the core engine of the business is highly inefficient at compounding wealth from its capital base. So let's summarize this entire investigation by weighing the evidence side by side. On the pros side, you have a glaring, almost unbelievable valuation setup. A massive 59.66% discount to fair value paired with a very healthy 9.39% earnings yield. But then, on the con side, you face these heavy structural burdens, a massive 10.28 debt-to-equity ratio, and a highly inefficient 0.64% return on invested capital. It is the classic battle between a cheap stock price and fundamental business flaws. Which leaves us with this final provocative question based on the health check we just ran today. Is Nomura Holdings a deep value discount just waiting for the market to wake up and correct its price? Or is that 60% margin of safety just an illusion, masking a debt-heavy trap with inefficient capital allocation? Well, the detective work is done, and how you weigh these vital signs is entirely up to your investing style. Thanks for joining me on this explainer. Keep learning, and I'll see you next time.